What's going on, y'all? Welcome to the latest episode of the Hashing It Out live stream. I'm your host, Colin Harper, head of content and research at Luxor Technologies. It's a beautiful Tuesday. Thanks for joining in with us. We took yesterday off on account of the federal holiday in the US and Canadian Thanksgiving. But for today, we are going to be jumping into network metrics like usual, including the latest on hash price, which just hit an all-time low yesterday on account of the most recent difficulty adjustment. And we will also cycle into our news, which includes Luxor's newly launched hash price derivative, a little update from Grayscale, which has launched a new fund to allocate capital into distressed mining assets. And we will wrap up quickly with just a little side note on Texas's crypto boom slowing in recent months and the Texas Blockchain Council's comments about future growth. So with that, let's go ahead and jump right into it. So as I was saying, yesterday, Bitcoin had its largest upwards difficulty adjustment since May of 2021. It was a whopping 13.55%, which is, like I said, the biggest that we've seen in over a year, and put Bitcoin's difficulty to a new all-time high of 35.61 trillion. Now, as a result of this, as you can see from this very, very pitiful hash price chart, hash price fell off a cliff following this adjustment. It went from about 7.75 of a cent per terahash per day down to about 6.75 of a cent dollars per terahash per day following the adjustment. And even since then, Bitcoin's price has fallen. So we've fallen even lower to, exactly about 6.75 of a cent from, 6 and 8/10 of a cent per terahash per day, or 9/10 of a cent. So like I was saying, this marks a new all-time low for Bitcoin's hash price on the USD denominated scale and on the Bitcoin denominated scale. If we look at the 7-day for BTC denominated hash price, we can see also not too much in the way of positivity there either. We went from 404 sats per terahash per day down to 355 sats per terahash per day. Now, this is just, absolutely brutal. If you're a miner, you know how difficult this is. A few implications here as we see hash rate surging. Number one, this puts a lot of miners either in the red or very close to break even. I believe that with this hash price, some new gen hardware, even something like the S19 or M30, some of those, if you're hashing at 7 cents or above, you are officially at break even or underwater if you're above that 7 cents. Other kind of new gen hardware on the less efficient end, maybe your 80 terahash machines with something like 40 joules per terahash, or 35, or like 40ish joules per terahash. Energy efficiency are also underwater. So basically, this most recent difficulty adjustment means that we should see a lot of miners who are up the cost ladder and higher up on the efficiency ladder in terms of more joules per terahash starting to fall off the network. But you wouldn't know it if you looked at the Bitcoin's hash rate, right? At least not right now. Even since the adjustment, hash rate just continues to climb. We continue to hit all-time high after all-time high. Looking at the 7-day right here, we most recently today hit 265 exahashes a second on the 7-day moving average. So hash rate's really not letting up. Blocks are still coming in pretty fast. We're only 10% into this current epoch, but the average is 8 minutes and 46 seconds. And right now it's estimating that the next difficulty adjustment will also be another absolutely nuclear upwards move. I wouldn't give too much credence to this number right now. Like I said, we're only a tenth of the way into the current epoch. That being said, the fact that we're already 10% in, given the fact that the difficulty adjustment was, just yesterday, is pretty crazy. I mean, blocks are coming in at an absolutely blistering pace right now. It's getting dicey out there for sure. Like I said, profit margins for a lot of miners are starting to close, and you're starting to see miners, in that $7 to $8 per or 8 to 7 cents per kilowatt hour, energy costs starting to either feel the pain or just completely be unprofitable entirely. So definitely something to keep an eye on as this month progresses. The good news, I guess, if there is to be good news plucked from this, is when something like this happens, it's not good news for these miners, but certain miners have to start shutting off because they're no longer profitable. Their margins are just completely squeezed out. So it's possible that maybe we see hash rate start to taper from here, and maybe the next difficulty adjustment isn't as bad as it's being predicted currently. But there's no guarantee of that. A lot of this hash rate is coming online, both from public miners who have gotten the newest machines like the S19 XP, M50, and even other machines in the S19 and M30 series. Pre-orders coming in, they're starting to plug those in. Some of these guys have the lowest cost of power and can actually sometimes stomach the losses there if this does, if they do end up having their profits squeezed out a little bit. Some of it's also coming from formerly ETH miners allocating energy that used to be, put towards ETH mining into Bitcoin mining. So they're swapping out their GPUs for ASICs, and that's part of the reason why we've seen such a staggering growth of hash rate over the last month, from 232 exahashes all the way up to 265 exahashes. 33 exahashes of growth in the past month. This is kind of changing a lot of people's, I think, expectations for what hash rate will be at the end of the year. Last year people were saying we would get to 300 exahashes at the end of the year. Midway through this year, people thought that wasn't going to happen, but now it's looking like that could be in play again. We're definitely at least probably going to see 270 to 280, but 300 not too far out of the realm of possibilities. And with that cheery note, let's go ahead and move over to the ASIC price index. We're starting to see ASIC prices continue to fall quite substantially. As you can see here for our most recent update over the last week, new gen machines, those on the under 38 joules per terahash bucket, fell from $29 per terahash to $27 per terahash. Your mid-gen and your older gen machines are not moving as much, and I think that's probably just a fact. That's probably due to the fact that there are fewer of these machines on the market actually circulating right now. Because, like I said, when I was talking about hash price, those machines are just, especially the older gens like the S9 and the above 68 joules per terahash bucket, those are no longer profitable for 95% of miners. Only those with dirt cheap or free electricity are going to be able to turn a profit with those. And it's starting to become the same with the mid-gen tier, right? The 38 to 68 joules per terahash. Those miners miners with those machines are probably finding it much harder to turn a profit unless they have really, really cheap electricity. So they're just not nearly as in demand, and they're not circulating as much. And that being said, new gen machines like the S19 series and the M30 series still are, and they had quite. So we saw quite the tapering last week, going down from $29 to $27 per terahash. Probably not the bottom. We're still in for a lot of pain unless Bitcoin's price decides to U-turn from here. So, it's conceivable that we see these S19s and other new gen machines get to as low as $20 per terahash this cycle. We've already started to see, Bitmain had that promotion for selling S19 Pros for $19 a terahash. So that's totally conceivable and within play from where we're standing. And all right, with ASIC prices in the bag, let's go ahead and jump over to our news for this week, which first and foremost, little plug for Luxor. We just launched our Bitcoin mining derivatives yesterday. This is, we're calling this the Luxor hash price non-deliverable forward, also known as hash price NDF. And what this is it's an over-the-counter derivative that is tied to hash price. So the basic idea here, and I will launch into this blog post from our derivatives team in just a second, but the basic idea here is that miners will be able to sell their hash rate forward for a set hash price to a buyer, right? So like imagine that you're a miner with, let's say, let's just call it 10 petahash, right? And let's say that you want to lock in a hash price of $70 per petahash. So using this contract, you can take your 10 petahash and then sell it to a buyer for to lock in basically $700 a day in mining revenues. And the short and simple here is if hash price goes down in that time frame, then you have hedged the loss that you would have incurred on your hash rate. But if hash price goes up, then you have lost out on potential profit and you owe the difference to the buyer. So this is something that that miners have been kind of asking about for a long time. We've been beating on this drum for a few years that we wanted to get this product off, off the launch pad and into the market. And yesterday we finally announced it that it has become a reality. The OTC desk is run by Luxor. Like I said, the actual price of the derivative is settled based on hash price over the contract duration. So if you did a 30-day hash price, if you did a 30-day agreement with someone using this contract, then you would take the average hash price during that 30-day and compare it to the closing hash price at the end. Or you would take the 30-day average of the hash price and you would compare that to the hash price that you locked in for the duration of the contract. So going back to that last example, let's say you're a miner and you sold a contract for 10 petahashes for $70 per petahash per day. If the average over that 30-day period for the contract was $65 per petahash, then you're in the green, right? If it's $75 per petahash over that 30-day period for the average, then you're in the red. If you would like to learn more, I highly recommend this blog on luxor.tech/derivatives/blog by our derivatives team, Matt Williams and Ben Harper. They go through all the ins and outs of the derivative, and a little more about how it works, and kind of why we decided to go with this model to start. A few other housekeeping items. The derivative is cash settled. So it's either settled with BTC, USD, or USD equivalents. And as for who would want to take the other side of the bet, obviously the people selling here would be miners. But we have also had a lot of interest from traditional financial institutions, proprietary trading firms, hedge funds, guys like that, who would potentially want to sell these contracts for non-physical exposure to hash price in Bitcoin mining, and so that they can, get that exposure, generate some alpha, and then potentially even, be able to rake in some mining revenue without having to actually touch Bitcoin mining itself. So all that to say, we are super excited about this. If you have any questions about this product or would like to contact our derivatives team, please do not hesitate. You can find some contact info on our derivatives page, which you will find here at luxor.tech/derivatives. You can learn more here, and you can also reach out to our team at the bottom here. And if you would like to sign up for our derivatives email list, you can do so here at the bottom of this page. All right, now that shameless shill is over, going on to our next news item for today, which is Grayscale's newest fund, which is looking to invest into distressed mining assets. Now, this was announced last week, and basically Digital Currency Group's Grayscale is setting up what it calls the Grayscale Digital Infrastructure Opportunities LLC. This will be open only to accredited investors. The minimum investment is $25,000. And the idea here is Grayscale smells blood in the water in the Bitcoin mining market. I mean, you don't have to look far to see this, right? Compute North just filed for bankruptcy in September. We're starting to see other miners like CleanSpark buy up assets from guys like Mawson and Waha Technologies. Argo most recently sold 3,400 S19J Pros for about, I think, $7 million. So these sales are kind of going on all around the mining industry. Some of them aren't, obviously not all of them are making news. Some of them trickle through the news cycle because it's a publicly traded company or a big, host like Compute North. But there is a lot of distressed assets and assets like Bitcoin mining rigs that just, either are not profitable for the miners that own them, there aren't rack space to plug them in, and a bunch of other operational delays and kind of hurdles for these miners to hit. And so what Grayscale wants to do is they want to take money from this trust and they want to purchase those assets. They are then going to take those rigs and then give them to Foundry, Digital Currency Group's mining arm and Bitcoin mining pool, and Foundry is going to manage them and mine towards Foundry's mining pool. Now, this has really this is kind of a 1-2 punch from Grayscale here, right? What they get to do essentially is they get to take the Grayscale Digital Infrastructure Opportunities LLC, and they get to attract more capital to Grayscale. Now, mind you, this is coming at a time where Grayscale's, let's see if I can find it in this article. Yeah, where Grayscale's net asset value for the Grayscale Bitcoin Trust, its flagship financial product, which has $12.7 billion in assets under management. This is trading at 35% discount to net asset value, which means that you can purchase an equivalent amount of GBTC for 35% less than you would if you were just buying Bitcoin spot. Now, obviously, GBTC comes with counterparty risk and a bunch of other things, but the idea here is Grayscale is not making money on this, or is not making at least as much money on this product as they were in the bull run, right? Where this was actually trading at a premium because institutional investors were just wanting any sort of exposure to Bitcoin as it was ripping. So this is coming at a time when Grayscale's Bitcoin Trust is not doing so hot in the bull market. So this gives Grayscale a new opportunity to raise funds and to attract capital. Now, the other play here, obviously, is fattening up Foundry's mining pool, because Grayscale is going to take all of the Bitcoin miners that it purchases according to this trust, and it is going to point them towards Foundry's mining pool. And now, another interesting thing here that I don't think that it has gotten too much coverage, but I wrote about it here in this article. Let me see if I can find it. We'll do this. Okay, well, I can't find it right now, but it's definitely in this article. Basically, the thing about this, I'm going to see if I can find it. Sorry, give me a second here, guys. Oh, yeah, here it is. It's possible that this fund actually ends up purchasing miners that Foundry's financing arm itself financed. Now, Foundry has a Bitcoin mining financing arm. And so, basically, miners come to Foundry, they want a loan to buy ASICs, and Foundry gives them a loan anywhere from, 10 to 20% interest, usually 20% being the high end, 15% usually being the sweet spot. Now, it's possible that this new Grayscale fund actually purchases rigs from miners that Foundry financed. And this is good for Foundry, right? Because now Foundry doesn't have to take custody of those rigs and then sell them to another party to try to recoup that capital. So basically, this is could be, assuming this is going to happen. Now, this is all speculation, right? This could be a clever way for Foundry to recoup some of the potential losses that they had on some of these loans, because miners are right now, especially if you have high energy costs and hash prices getting obliterated, a lot of these miners aren't turning enough of a profit to be able to pay back these loans on time and to be able to cover the interest on them. So in addition to fattening up Foundry's Bitcoin mining pool potentially, this could also be a way for them to recoup some of the capital on some of these loans. And one last thing for context here, Grayscale is not the only shark in the water, so to speak. As you all might recall, Bitmain co-founder Jihan Wu recently launched a new fund through his new venture Bitdeer, or Bitdeer has actually, put money into this new fund to buy up distressed assets as well. So this new fund has already contracted $50 million from Bitdeer. It's seeking up to $200 million from other investors. And the idea here is to do the same thing, is to bid on distressed assets, Bitcoin miners, maybe data centers, things like that. They might even end up purchasing equity, as a Grayscale representative told Forbes for this article. So one thing to just a thing to keep an eye on, especially as you go into Q4. A lot of miners are feeling the pain We're already starting to see some of them liquidate assets or declare bankruptcy in Compute North's case, and there should be plenty of opportunity to scoop up distressed assets on the cheap as this bear market wears on and hash price continues to get crushed. And on that note, speaking of getting crushed, it looks like that Texas is not going to see as much growth in the Bitcoin mining sector as previously projected. This is an article in Bloomberg. I am using the Yahoo Finance Spanish facing syndication platform to get the full article because I could not get past the Bloomberg paywall. But so this article, it's not very long. I just want to get the point across. Basically says that Texas's crypto mining capacity will not grow as quickly as previously forecasted. This comes from projections by the Texas Blockchain Council, and Lee Bratcher, its president, told Bloomberg that mining capacity in the Lone Star State will increase by 2 gigawatts to 3.5 gigawatts by the first quarter of 2024, rather than the former forecasted 5 gigawatts. Now, going back to what we were talking about with mining economics, miners got a little overzealous in the bull run. They bought a bunch of machines. A lot of miners were flocking to Texas, and they really just bit off more than they can chew. Many of them are not going to be able to get all of those assets online. But further exacerbating this is just a general energy crunch, right? You have all of these miners coming there. They need a lot of energy. And as we saw this summer, Texas's grid, depending on the season, could be stressed, right? If there's a heat wave going on, everyone's got their ACs cranked up. It's a lot harder for Texas to pipe energy to all the places that it needs to, residential, commercial, industrial, especially when there's a heat wave, because Texas has a lot of wind power. And for those of y'all who are paying attention, you probably know during that heat wave, that wind power was underproducing by a lot. In fact, the Energy Information Association, I think is the name, the EIA of the U.S. Arm of the U.S. government, released a report recently that said, Texas's grid problems last summer or this past summer were less to do with electricity demand and more to do with unreliability of wind power. But all of that to say, there's a lot of energy in Texas, but there currently is not enough capacity to support all of these miners trying to come to Texas. Couple that with some miners who are just not going to be able to actually finance the operations that they were trying to build out in the bull run. And it looks like Texas is going to have a lot less Bitcoin mining capacity in the future than we thought it was going to originally. Now, that being said, it's still going to be a lot, but this frees up the opportunity for other states to kind of soak up some of that excess that will no longer be able to be in Texas. And with that, y'all, that wraps up this latest edition of the Hashing It Out live stream. Thank you so much for joining. We really appreciate all y'all tuning in. If you like the show or have any feedback, please do not hesitate to add us on Twitter or share this show. You can find us on Twitter at HashrateIndex and at Luxor Tech Team. And if you would like written analysis every week in your inbox, please subscribe to our newsletter at hashrateindex.com/blog. And like I said, if you have any feedback or if there's any topics that you would like to see us cover for future live streams, please let us know. And with that, I hope you all have a beautiful week and happy hashing.